Hello and welcome to Juske FX, where we provide you with everything you need to know about Forex trading. In this video, we will cover two topics: currency pairs and candlestick charts. Currency pairs are the backbone of the Forex market. They represent the value of one currency relative to another currency. For example, the euro against US dollar pair represents the value of the euro relative to US dollar. Understanding currency pairs is crucial to success in Forex trading. So let's dive in. There are three types of currency pairs. There is major, minor, and exotic. Major currency pairs are the most heavily traded pairs and include the euro against US dollar against Japanese yen, Great Britain pounds against US dollars, and US dollars against Swiss franc. These pairs are known for their high liquidity and tight spreads. Minor pairs, also known as cross pairs, include currency pairs that don't involve the US dollars, such as euro against Great Britain pounds or Australia dollars against New Zealand dollars. Exotic currency pairs involve currency from emerging or smaller economies, such as US dollar against Turkish lira or US dollar against Mexican peso. The main problem with exotic currency is that they have a really big spread, and trading that I recommend in cases that you're going for long-term periods trying to catch political news in specific countries. When looking at a currency pair, you will see two prices: the bid price and ask price. The bid price is the price at which you can sell the base currency, while the ask price is the price at which you can buy the base currency. The difference between the bid and ask price is called the spread, which we talked in the previous lesson. So, how do you read a currency pair quote? Let's use a euro against US dollar as an example. The quote might look something like this: 1.0905 and 1.0908. The first number is the bid price, and the second number is the ask price. The difference between two prices in this case is 3 pips. Pips, as we talked in the previous lesson, represent the smallest movement a currency pair can make. Another topic we are going to discuss today is candles. In this section, we will discuss what candlestick charts are, how to read them, and how to use them to make informed trading decisions. First, let's talk about what a candlestick chart is. Essentially, a candlestick chart is a visual representation of price movement over a certain period of time, typically ranging from minutes to months. Each candle on the charts represents a specific time period and displays the opening, closing, high and low prices on that period. Candles are made up of two main components, the body and the wick. The body represents the opening and closing prices and is often colored differently to indicate whatever the price went up or down during that time period. If the closing price is higher than the opening price, the body is typically colored green or white. For example, we can see a green candle on March 13, where the opening price was around 1.064 and the closing price was 1.073. Also, we can notice a wick above the candle, which indicates that the price was around 1.075 highest in this day and then went a little bit below and closed it. If the closing price is lower than the opening price, the body is typically colored red or black. We can see a candle on March 15 where the opening price is above the closing price, which showing us a bearish candle. We can see that on this day the opening price was around 1.073 and closed it at 1.057. Also, we can notice a wick on both sides, which indicates that at the beginning the price went up until 1.076 and then went down to 1.051. But in the end, it went a little bit up and closed the candle at 1.057. Also, I'd like to include that the wick represents the high and low price during that period and can also be referred to as a shadow. Reading candlestick charts can take some practice, but the basic idea is to look for patterns and trends that can help you predict future price movements. For example, if you see a series of green candles with the long bodies, this could indicate that the price is on the uptrend. Conversely, if you see a series of red candles with long bodies, this could indicate that the price is on the downward trend. However, we will discuss movements and chart patterns in the next videos. Another important factor to consider when using candlestick charts is the time frame. Different time frames can give you a different perspective on the price movements. For example, a 5-minute chart will show you price movements over a much shorter time period than a daily chart. It's important to choose a time frame that aligns with your trading strategy and goals. As we talked before, our candles of March 13 and 15, if we change the time frame from 1 day to 1 hour, we can see all candles that went up and down, but all indicates the same price movement of the day. So there you have it, an overview of currency pair and candlestick charts. Currency pairs are the foundation of Forex trading, and understanding how they work is essential for any trader. We discussed the 3 categories of the currency pair: major, minor, and exotic, and explain how to read currency pair quotes. We also covered candlestick charts, which provide valuable information about the price action and market sentiment. Remember to pay attention to the time frame you are using, as it can have a significant impact on your analysis. With those tools in your trading arsenal, you will be well on your way to success in the Forex market. Thank you guys so much for watching. Smash the subscribe button below. Check my description for the blog and brokerage which I'm using and recommending. And I will see you in the coming videos.